What if I told you that the roaring expansion of 19th century America, the rise of cities, factories, and unimaginable wealth was fueled not only by steam engines and iron tracks, but by relentless speculation that could make fortunes or destroy them overnight? Railroads were the arteries of the young nation, connecting the farthest towns, opening markets, and igniting dreams of prosperity. But along with opportunity came risk, greed, and chaos, especially in the bustling heart of Wall Street. Investors, brokers, and opportunists rushed to profit from the promise of railroads, buying and selling stock based on rumors, forecasts, and a hope that the iron rails would carry America into a golden age. In New York, the streets around Wall Street were alive with energy and tension. Brokers scrawled orders in hastily kept ledgers, newsboys shouted headlines, and merchants and bankers whispered deals in crowded coffee houses. It was a world where the next big railroad could make a man rich beyond imagination or leave him bankrupt within days. By the 1830s and 1840s, railroad mania gripped the nation. Companies like the Baltimore and Ohio Railroad, chartered in 1827 as America's first common carrier railroad, promised new wealth as investors poured capital into tracks and locomotives. In 1835, the railroad bubble began to inflate as stock prices skyrocketed far beyond the actual revenue and prospects of these companies. Wall Street brokers, eager to meet the demand, encouraged speculation, while newspapers and word of mouth amplified the excitement. Every new charter for a line, every announcement of a new locomotive, and every rumored merger became fuel for the frenzy. Ordinary citizens, farmers, artisans, and merchants scrambled to invest, often mortgaging property or borrowing heavily to buy shares, convinced that railroads would turn them into millionaires. Yet this boom was built on fragile foundations, incomplete infrastructure, mismanaged funds, and overly optimistic projections of traffic and profits. By the 1850s, speculation had reached new heights. Railroad companies multiplied like wildfire, and Wall Street became a theater of risk and reward. Prices of shares often bore little relation to actual earnings, and brokers sometimes engaged in outright manipulation, pooling resources to inflate values temporarily before selling at peak prices. Notable examples include the Erie War in the 1860s, where figures like Jay Gould and James Fisk engaged in legendary battles to control the Erie Railroad, employing bribery, stock manipulation, and public deception to gain the upper hand. These stories captured the imagination of the public and became cautionary tales about the volatile marriage of ambition and speculation. In parallel, smaller investors, many of them first-time participants in the stock market, faced ruin when deals collapsed or false information misled them. The tension in Wall Street was palpable. Coffee houses, broker offices, and early trading floors buzzed with chatter, orders, and the rising sense of imminent danger. Yet, amid the frenzy, progress marched on. The construction of transcontinental lines, including the Union Pacific and Central Pacific Railroads, promised to unite the country's coasts, transport goods faster than ever, and create new economic hubs. Investors and brokers alike learned to balance risk with opportunity, understanding that while speculation could destroy, it could also catalyze innovation and expansion. By studying patterns, evaluating company management, and relying on emerging financial reports, some brokers were able to navigate the chaos successfully, turning the railroad boom into long-term growth. The contrast between reckless speculation and calculated strategy illustrated the dual nature of 19th century finance. The potential for enormous gains existed alongside devastating losses, and Wall Street itself was learning the rules of a market that could shape the nation's future. Inevitably, the fragile bubble began to crack. Railroad speculation brought with it financial disasters, most notably the Panic of 1837, triggered by a combination of wild speculation, bank failures, and tight credit policies from President Andrew Jackson's administration. Investors who had poured their life savings into railroad stocks suddenly found themselves unable to sell, while brokers faced mounting liabilities. The crash rippled through Wall Street like an earthquake. Banks collapsed, businesses failed, and families lost property and security. Panic-stricken traders shouted in desperation as news spread. Coffeehouses became arenas of fear and accusation, and brokers scrambled to calculate losses and cover debts. What had once seemed a world of limitless opportunity had transformed into a stark reminder of the dangers of unchecked speculation. The lesson was brutally clear. Financial markets were powerful, but they could also be unforgiving. Yet the story of 19th century railroads is not just one of ruin. After each crash, Wall Street and its brokers learned, adapted, and rebuilt. By the 1840s and 1850s, reforms emerged. Companies improved transparency. Reporting became more consistent, and brokers developed sophisticated techniques to evaluate railroad profitability. Figures like Cornelius Vanderbilt demonstrated how careful strategy, insight, and patience could turn the railroad boom into lasting success. Vanderbilt, for example, built a transportation empire by consolidating lines, improving efficiency, and anticipating shifts in supply and demand. Other savvy investors applied similar principles, separating speculation from calculated investment, and helping to stabilize markets even in times of volatility. Slowly, confidence returned, fueled by visible progress. Rail lines stretched across states, cities prospered along new tracks, and commerce accelerated in ways previously unimaginable. By the late 19th century, the combined lessons of speculation and collapse had created a more mature Wall Street. Brokers had developed a sharper understanding of risk. Government regulations were beginning to take shape, and investors became more discerning. The railroad boom had transformed the American economy, connecting regional markets, facilitating trade, and giving rise to new industries. Wall Street itself emerged stronger, more resilient, and more sophisticated, capable of handling the high stakes and rapid expansion of a growing nation. The payoff of these turbulent decades was clear. Despite crashes, scandals, and human error, the railroad booms laid the foundation for modern finance. They demonstrated that risk, innovation, and ambition could coexist, and that, even in the midst of chaos, strategic thinking could turn disaster into opportunity. By studying these historical booms and busts, we gain not only a deeper understanding of Wall Street's evolution, but also timeless lessons about finance, human behavior, and the enduring power of calculated risk. The iron rails that carried trains across America also carried the spirit of Wall Street itself, relentless, ambitious, and unyielding in its pursuit of growth, wealth, and progress.